thanks everybody for joining us. I'm Chris Wiley. I'm the co-founder of Tasty Equity with my brother Peter. We have a great team, including Elena, who's with us today from Investor Relations. Ned from Investor Relations, who many of you have talked to, is actually in the audience, so he has an audience view today, but he'll be aware of or Elena will share the chat stuff with him potentially. I'm going to rock and roll here through like 15, 20 minutes to give you a quick update on where we are, how we got here, and where we are going. There's been some great opportunistic changes to where we are and why. So I can get the screen to move. Today, we're going to have three topics. Number one, we're going to talk about delivering on our promise, how we have grown from 4 to 11 locations in this past year. Our goal was to get to 10 locations per year, and we beat by one, thanks to a retiring franchisee that we had the opportunity to participate in an acquisition. I'm going to explain more of the details on that. Currently, we manage those 7 additional locations. We'll talk about the details of equity in a minute. We're going to go into the immediate acquisition opportunities that surfaced literally in October. We have a number of hothead burritos operators where hothead was not their core business, where they had some other business and they opened one hothead. And during the downturn, they were struggling to focus on their core businesses, which range from Dairy Queens to Burger Kings to real estate development companies. So we'll talk about that. We have an opportunity right now, immediately on our plate, where these folks notify corporate that they want to sell their stores. And obviously, they're at a fire sale price. So we're going to look at taking over those. We'll talk about that when we get there. And our customers are just back and forth. It is crazy. If you've seen anybody follows CNBC and all the business reports, you see all the retailers are up 5, 7, 10%. I'm going to tell you what's driving our nearly 10% sales gains. Partially, it's customers spending money like drunken sailors. But thank you for all of you who are investors with us. We have over 2,200 investors. We did have we paused. We didn't completely pause. We slowed down our offering in terms of advertising, in terms of activity for the last 3 months because we were converting off of a platform to a new platform. It's much smoother. It's faster. It doesn't lose your data. I could not be more frustrated with the past vendor, but the new vendor is awesome, and it'll be better for everybody along the way. We'll talk about that a little bit, but we continue to grow. So really delivering on our promise is all about executing the plan, and the plan was in 2021. This is the same slide we've been using since 2019. Our goal was to get from our 4 stores to 10. 10 more, technically, let's be fair. We wanted to have up to 10 restaurants operational by 2021 because, getting a project started doesn't mean it's open. It could take 6 to 9 months and even 12 months to build a location where there's no building. So we are now at a total of 9 hotheads that we operate and manage and 2 rapid fire pizza locations that we own, operate, and manage. We feel really good about being ahead of plan despite COVID, and part of that is thanks to the CARES Act government relief funding that allowed us to just keep the foot on the gas pedal through COVID. We never laid off anybody. We had a lot of people quit because they didn't want to do it, but we just continued to grow our business. We're going to talk about our sales gains in a minute, but delivering on that promise was all about buying more stores quickly. This came up opportunistically, just like the ones I mentioned a minute ago. So way back in September, take that back. Way back in January, February of last year, a very seasoned 75-year-old franchisee who is a former very large Burger King operator. He had sold off all his Burger Kings and he bought into the hothead system as an area developer to give his sons away to get into business with him. He developed a total of 7 locations in Northeast Ohio in the Youngstown, Cleveland, and Pittsburgh markets, essentially right across the street from his old Burger Kings. It was a simple strategy. Just he knew the markets worked. He wanted to put more stores in. That's a multi-brand strategy that we employ as well. Don announced he wanted to retire about 9 months ago. We went into a process. So as Tasty Equity, we went to our bankers and said, we haven't raised as much money as we'd hoped to yet. Can we do this deal? And our banker said, you're not ready yet. This is a $3 million transaction. It's too big for you guys to do by yourself. When I say by yourself, the Tasty Equity entity, which is our public offering entity. And what they did is they said, instead, you can partner with a private investor who's got a little bigger balance sheet and do the deal, and then we'll work out the equity later. So we added the 7 locations. They are very profitable. They had the highest performing stores in the entire 85 store chain. We manage them. Pete and I personally are shareholders in the entity that acquired the stores. And my lawyer wanted us to be very clear. When you buy equity today, when you buy stock today, you technically don't get equity in those 7 locations yet. But Pete and I are committed. We've got a verbal agreement with our partners for essentially warrants on the equity, so that our Tasty Equity investors will be getting equity in those stores. The legal paperwork on that between the bankers and SBA and the SEC is probably going to take into January, February, but we are committed to getting that done. And then any investor with us today will just automatically have equity in those restaurants. When you invest with us, you own a piece of all the restaurants that Tasty Equity owns. And Tasty Equity typically owns 20% of the restaurants, but has a management arrangement to earn more than that in terms of the profits, because we're putting up the cash for the deals. Meet our 7 locations. Anybody who's from the Youngstown area or Cleveland or even over in Pittsburgh, these stores, Austin Town, Boardman, Canfield, Niles, they ring around Youngstown. There is a Youngstown location we're going to talk about in a minute at Youngstown University, or YSU, that we are looking at buying from a franchisee that will help plug some holes. We're going to talk about that in a minute. But these 7 stores were essentially where Don built his Burger Kings. 2 of them are up in Cleveland, in Strongsville and Brunswick. And I'm proud to say that the operations team that all stayed with the company when the owners left, when the owners were bought out by us, Mauro and Jackie and Eddie are just awesome. They literally went to the Brunswick and Strongsville stores, which were underperforming because they were kind of being attended to by younger members of the family that didn't have their head in the game as much. And we took those stores from $8,000 a week to $12,000 a week, completely rebuilding the crews. That is a huge profitability swing in this business. And a couple of these other stores do $30,000 a week, which is on par with the best of franchise brands. So we're really excited to have these new locations. You'll see more photography and more of the crews, but don't forget about our first 4 locations. We started this business by building the top right store, Lima, when my son came out of the military, and it was a dream of his to be part of the family restaurant business. We actually technically did a 5-store plan. We built that store. He parachuted in to run it. That's actually a grand opening photograph. The Bowling Green rapid fire right below it, we built 1 year later using the cash profit from the Lima store. So we invested $100,000, and that produced 2 restaurants. Then in the middle of the grand opening week of the Bowling Green store, a hothead franchisee announced that he was desperate for cash. He was facing a bankruptcy. He had a different unrelated business fail. And in order to save his home, he wanted to sell the hothead. So we bought the Perrysburg and the hothead stores with 0 cash. We did it because of our credibility. Our banker said, hey, you're getting it 60 cents on the dollar. And they wrote the paper for us. We took over those stores. Like the Strongsville and Brunswick stores, they were doing $8,000 a week, which is terrible. Hotheads are supposed to do $12,000, $15,000, $20,000 a week. Today, after we've owned those stores, we turned them around way back in 17 and 18. We just remodeled them during COVID. It was a good time to do it. The customers weren't inside the restaurants much. It was all carry out. But the point is, they were a takeover story. We took over underperforming restaurants. We turned them around. We remodeled them, and they're kicking butt now. So today, our immediate strategy is to repeat that again. As I mentioned at the beginning of the presentation, we have, at this point, there's 6 more franchisees. Actually, it's 7, because I updated the map after we started the slide. There are 7 franchisees that are within our service areas of Northeast and Northwest Ohio that have raised their hands, sent the formal notice to the hothead franchising, and said that they want to sell their store. Now, an example, the guy in Toledo and Findlay on the left-hand side, those are well-performing stores. The problem is the owner lives in Michigan and he has a very large other business. And so he wants to sell his well-performing stores. We are very friendly with him, and we are talking about getting that done. Over in Northeast Ohio, we have 5 franchisee locations, which I alluded to earlier. In that case, these are folks that are, they have other businesses. One has multiple Dairy Queens. One has 7 or 8 coffee shops. One is a real estate developer. And during COVID, those core businesses for them were massively impacted, and their time and energy went into saving their core businesses. So their hotheads were really neglected. So while the rest of the franchise system, by and large, was running 5 and 10% sales gains over the prior year, those stores were simply underperforming. And we believe that based on their underperforming circumstances, that we'll have an opportunity to get involved with taking them over, getting control of them, and we can move very quickly. By the way, Elaine, I see Ed is raising his hand. I'll let you deal with that, and we'll come to questions here as soon as I get through the slides. We'll have 40 minutes to handle all the questions. Elena will accumulate them, by the way, in the meantime, so feel free to keep chatting them in.
Yep. And I'm just so you know, I am responding. There's a couple of people interested in more investments. They're really interested in what you're presenting. So I already have texted Ned some of the communication. And then at the end, we have a couple questions on new locations, other locations. So we'll just keep going, and we'll get to all.
I'll keep rolling. So basically, our strategy of 10 stores a year was to find new locations and build new restaurants. By the way, we are a leasehold tenant. We're not in the business of building buildings. It is not compatible with our tax structures that we utilize. We'll talk about that in a minute. We always want a landlord that will provide a location that's prime retail, and we do work with build-to-suit situations where a landlord will put up a building and then we become the tenants, and we get a sweetheart deal for doing that. But these stores, these 7 stores that became available that I use little Target bullseyes for, that it's not Targets, those are just, that was a convenient little icon. These stores are within our service area. We can, conceivably within the next 60 to 90 days, get deals cut with each of them as much as our bankers will permit, and get control of those, either total takeovers, joint venture, however we might do it, so that they can go focus on their other businesses and we can take these and maximize their performance. That it's much easier to take over a restaurant and turn it around than it is to go through the location selection and build and development and grand opening, which takes 6 to 9 to 12 months. So we think we can get between now and Q1, we are totally focused on getting control of as many of these restaurants as we can, giving us the potential to get to as many as 17, 18 restaurants under management. And again, equity. In every case, our goal is for us to have a material equity position, which is shared with our Tasty Equity investor partners. All of this is supported by the fact that the CARES Act funding is still flowing. I don't want to talk about people's political positions. What I want to say is that the fast food business would have been devastated without PPP and without what's called the Economic Injury Disaster Relief Loans, or the EIDL loan program. We received a couple of EIDL loans, had some complications on others, and now EIDL 2 is literally doubling the amount of allowable funding. Basically, it's just a modification to our original application. So we have 2 locations that are already eligible, and at the final stages of getting the loan modified to where we would receive up to $350,000 per restaurant from SBA. Now that's long-term debt for us, but it allows us to retire our expensive short-term debt. It allows us to then really do this, create a big cash reserve. It allows our bankers to have more confidence. So if we have another 7-store acquisition, this time the bankers will look at our bank account and go, oh, you have multi-year cash reserves, right? Yeah, you've got long-term debt, but everybody has long-term debt. So if you've got a good balance, it increases the confidence of the bankers. It also increases the confidence of the landlords. after what everybody's been through, landlords are terrified of consumer and retail tenants, and they want to make sure they can pay. And on top of all this, we have a couple private investors. One is a personal friend of mine. One is a personal friend of a dear friend of mine, that both are like me. I have a long time. I've been consulting in the mortgage industry for 25 years. It's a very lucrative industry, but it's super volatile. And my friends are like that. They've had very large liquid investment returns. Now they want to move their money into something that's long-term cash flow, like restaurants. So this is, they will become limited partners. What this does is, when we raise, if a restaurant takes $100,000 to open in cash, $500,000 total project budget. If I have my limited partner friends here, if I only have to put up $50K in cash, that means us, Tasty Equity, you guys with us, we're only putting up $50K of our cash. The other private investor matches us 50. We can do twice as many locations. Everybody, this is a 3-year plan to have as many locations as humanly possible. As the restaurant system, crosses 100 locations, it gets to 150 locations, and maybe in 3 years is approaching 200 locations. The value of our stores triples as the scale of the brand goes up. So I don't want to own 100% of a store. I want to do as many JV deals as possible. So some of you in the audience may say, well, I'm interested in investing, more than $15,000, I think, which is the top level in our public offering. If you're in the market to invest $25,000 to $50,000, that's a limited partner conversation, and that's what Elena is part of our team to manage. Again, I'm running over, guys. I apologize. I know we had a couple distractions, so I'll keep moving as fast as I can. Just to recap, we want to acquire the locations with the bullseyes, because those are active restaurants that are running right now. They're not terrible. They're just neglected because their owners are focused on their other businesses. We want to try to get these done, as many as possible, whether it's 2 or 3 or 1 or 6. We want to get it done as soon as possible in Q1, and starting now, but it'll take into January, February, March. Then these are the cities in Northern Ohio where we've already run the demographics. Our friend had Burger Kings there. We can pull data on it. We'll talk about that in a minute. So we want to acquire now, and then in Q2, Q3 of 2022, we'll focus back on leasing locations. Again, signing a lease just means you're 6 to 9 months away from getting a store open. So we have to have a dual-pronged strategy to keep on target to get 10 new locations added to our portfolio each year. Now, by the way, we can develop in any of those gold states, but we are focusing in our backyard. For any of you who have questions about where we're building stores, we have talked in the past about going to Florida, where all the gold states have area developers for the hothead system and or the rapid fire system. But we are finding that we've got so much opportunity right in our backyard between our new footprint from Pittsburgh through Ohio, up into Detroit, over to Indianapolis, that we want to, let's get 10 there first, and then we'll expand and do joint ventures with the area developers in other markets. The 10 per year is the key. And the reason is, if we take $1 million, forget the matching funds, if we raise $1 million, that's $100,000 down payments. That funds 10 stores without us having any matching funds, but I've already got matching funds, so that could do 20 stores potentially if we could find that many locations. But those 10 stores, once they're operational, they create the cash flow to fund the next 10 stores. And then the next year you have 20 locations, plus or minus. I mean, we already have 11. So if we open 10 over the next 12 months or get control of 10, then as we go into the end of 2022, we're producing cash to then take over or build 10 more. It becomes a perpetual flywheel. We are not in this business to just keep selling stock and diluting our shareholders. Our goal is to raise a certain amount of money. We filed for $5 million and then stop, and then let that flywheel build more stores. And the bottom line is, those stores, when you build them, they're valued at about $500,000 because that's your build cost. But once they're at scale, and we have 30 restaurants as a group, the valuation goes up, the multiple of profit. For those of you who are investors, the EBITDA multiple goes from 4 times EBITDA or profit per year to 12, 10 and 12 times. So suddenly our 30 restaurants are valued at like $24 million if we get to 30 restaurants within 3 years, but our bank loans that it took to build them are only 12. The difference is $12 million in value creation. So if we get it half right and create $6 million, it's still fantastic for our investors and for us personally. We're all in this together. So we are in a data-driven business. This is not just driving around looking at stores. We buy data. We buy specific data about the actual, all the branded restaurants, what their sales are. You know, we don't want to go into a market where fast casual is not the leading brand type. If the leading brand types are blue plate, retirement type, full service restaurants, that's not where fast casual flourishes. So, and we want to go into markets where Chipotle's already taught people to eat burritos, right? We just don't want to go across the street from them. We believe, we'll talk about our product, but we have better product. We're going to talk about why in a second. So I kind of already covered this. Our goal in 2022 is to raise $1 million more. That'll fund $100,000 payments, or 20 if we split with our limited partners, generating up to $100,000 a year per restaurant. So it could really create very, very large cash flows. I can tell you, when we acquired the 7 restaurants that were very well run by a very seasoned operator, the cash flows were everything we've said. They weren't. So I've always said since our early webinars 2 years ago that the goal is each restaurant to generate about $5,000 in cash flow, net of after debt service and everything. So free cash flow, about $5,000 a month per restaurant, is the goal. When we bought that super well performing set of 7 restaurants that actually had 2 dogs in it, guess what? They were generating $5,000 a month per restaurant. Our 4 stores, guess what? They generate about $5,000 a month per restaurant. So these are real numbers, and that's the free cash flow, not the EBITDA. The EBITDA is more like 100, but the free cash flow is 50, 60,000 a year. I hope this is helping you guys who are hardcore investors. I'll go quick here. The Tax Cut and Jobs Act way back in the end of 17, which actually happened in 18, increased what was called bonus depreciation from being able to take that $500,000 investment in the project of a store and take $500,000 of write down over the next 1 to 5 years. At the time it was only 50% credit. You could only write down $250,000. They increased it, and it's still there, and the laws are still in place, and they're not being taken away by CARES Act stuff. It's still 100% bonus depreciation. I'm not going to try to explain this chart, but I just thought it's a cool picture. Here's the simple message. If I build a $500,000 restaurant, and that restaurant produces $100,000 a year in GAAP net profit, I can write off $100,000 a year for 5 years. Literally tax-free operations for 5 years. It's a little bit different if we take over an existing restaurant, but this just is so compelling. As my brother Ray, who's the founder of both Hothead and Rapid Fire, has told me for 20 years, never stop building restaurants. If you stop building the restaurants, you lose all your tax protection. It wears off after 5 years. But we're talking about a 3-year investment horizon for people who are investing with us today. We believe we'll see a liquidity event after, at 3 years. I mean, we're going to orchestrate one with one of the big funds who would invest with us to help us grow to even more stores. They don't buy you out and send you home. They invest in you. Some of you may have just seen the big announcement about Firehouse Subs being bought for $1 billion, but we're not that big. There are tier 2 funds that do the deals with brands that have 100 to 200 locations, and that's what we're looking for. I said earlier, customers are back in force. They are. I mean, this is just a fun little photo. People actually showing up and eating in the restaurant. I think I mentioned, and I'll show you in a second, that we are literally, well, I'll come to it in a second, that we are crushing last year, but it's all been carry out. It's people line up to the door, order the food, and leave the restaurant. They don't sit in the restaurant because of COVID. Well, guess what? Now they're sitting in the restaurants. They're filling the booths again. It's, laughing, smiling, fun again, rather than everybody completely hidden behind masks. It's just, I mean, hallelujah. Hopefully this fifth wave thing doesn't impact us. It's even impacted the big, analysts in the market. Technavio is a big analyst in the restaurant industry. A year ago, they forecast that the fast casual industry was going to flourish despite COVID, and that it would be a $63 billion growth of the industry. That's incremental growth, which means same store sales and more sales built by all the players like us. Then they updated it for the impact of COVID-19 just about 6 months ago, and they redoubled that to $150 billion in growth. Again, it's a combination of all the factors. They forecasted a 12% growth rate. Guess what? We're running 10% sales gains. I'm not saying we're geniuses. What I'm saying is we are riding the wave, and we have operational efficiency, and we're way outperforming the, let's call it, stores that are not attended to well. Our Hothead Burritos brand, for those of you who aren't familiar with us, is essentially Chipotle on steroids. We have dozens of custom hot sauces, so you can make it taste any way you want, from sweet and salty to creamy and sour cream if you want, or ranch dressing. Chipotle is one way, their way, or the highway. We are any way you want it. Burritos, tacos, street tacos. Sorry, I got to show a picture of that. It's street tacos. We got burritos. We have bowls. We have awesome sides. Like we brought queso to market 3 years before Chipotle did, and theirs sucks compared to ours. I can say that because it's my personal opinion. And customers are not just buying burritos and bowls now. Customers like never before, partly because our crews are upselling and cross-selling with amazing effectiveness. They're getting orders of queso on the side. They're getting chips and salsa on the side like you'd have at a traditional Mexican restaurant. All of this is part about having the customers come back into the restaurants. In the sales for our original 4 stores that you own equity in right now today, the black line is even against last year. Well, we've had 2 stores bumping and grinding a little bit, but coming up. But by and large, our stores are well above. I mean, look at some of these gains. We're beating last year by 20%, 40%, 30%. It's crazy. So these are stores you own equity in right now. The other 7 stores we'll talk about in a second. So Rapid Fire Pizza brand, I mentioned earlier, is that the dine-in pizza restaurants, all of us, including our direct competitors, Blaze and Mod, everybody closed some restaurants. These stores were impacted 50% drops in sales. Now, we only closed 2 in a downtown area, or in, let's call it, metropolitan areas where nobody's working there anymore. There's no traffic. There's no lunch business. But aside from that, the ones that we kept open are all very healthy, and they've come right back. They were down 25 to 50%. They're now at running sales gains against the prior year. But really, this is all how Papa John's, Pizza Hut, and the other guys, Domino's, all dialed in their digital business. And let's face it, why would you go out and do carry out when you can have it delivered for $10? So those guys crushed everybody in the dine-in business. Now we're getting our revenge. People actually want to go out. When people come to a Rapid Fire Pizza location, they pull 2 tables together. They sit 6, 8 people at a time, whether it's college students or families. It's group food pleasure, right? That's what we are. We're an aspirational brand. Now, somebody asked earlier, what do we think about the sale of Rapid Fire? I am intimately aware and very comfortable with Mike Kern, who's the CEO now of Rapid Fire Pizza, and his partner, Chip Hurst, who's a real estate development partner of his. Mike Kern was the chief marketing officer at Yum Brands for a number of years. And when they spun off Long John Silver's, they appointed him CEO of Long John Silver's for the IPO year-long process. And then he essentially retired. He hooked up with Chip about 5 years ago and became a Rapid Fire area developer because he wanted to get back in the game. He studied our business. Literally in October, he made a completely unsolicited offer and said, "Hey, Ray, I see the potential of this brand. I want to let you go focus on Hothead Burritos. we can take this brand and make it a aspirational brand, take it to the next level. He's a genius marketing guy. And what they did is they retired all the debt of the company, which, like any company that was building aggressively, had a lot of debt. That freed up cash flows. They have marketing strategies. They're currently just wrapping up their listening tour, going around to all the 35 odd locations and meeting the management teams and the franchisees and getting ideas from people like us. So I could not be more excited. I think they're going to pour on the gas. It'll probably take until January, February, maybe even March before the new marketing campaigns start to launch. But as we see the rapid fires return to, consistent, persistent sales gains, then we're going to start to, look at locations. We even have a strategy to work with real estate developers to put up a 3 or 4 unit building, and we'll put a rapid fire and a hothead in it to anchor it. And doing that gets us a free restaurant. We'll talk about that on another webinar in the future. So rapid fires are, if you don't know them, they are like Blaze and Mod on steroids. Blaze and Mod use a pizza oven where you have to paddle in the pizzas one by one. You can only cook 12 at a time, and they all get burned on the edges. No, we use super high-speed conveyors. It's controlled incineration. It's pizza, pasta, and calzones in 180 seconds with just a staggering number of toppings. Our biggest problem, you see that line in the back of this picture, is it takes customers too long to decide. So we've really been promoting our digital ordering so the regular customers can punch it up with their thumbs and then just go pick it up right at the cashier. So we're working on that business. We do think one of the challenges was giant lines to the door. So switching gears to the 7 stores that we acquired, again, I am way over, Elena. I apologize. I'm willing to go longer for anybody who wants to stay on for question and answers. But just to get through the last of this. So the 7 stores we acquired, there was 2 low performing stores. You see those below the water line here. And those have just turned around in the last, October and November. We completely changed out the crews, basically, rehired, retrained, and rebuilt the 2 stores that were underperforming. And again, credit to the management team, Mauro and Jackie and Brandon over in our other 4 stores. They're just doing a fantastic job. The crews are enthusiastic. In fact, we deployed 4 new benefit programs, from 401ks to instant pay, about to deploy tuition assistance to change the game in the recruiting. And I'm proud to say, everybody's talking about supply chain problems. Well, we have them, getting chicken, meats are overpriced, but they're all starting to come back down now. And the employment problem, we're proud to say we hired 11 managers from assistant manager to general manager level in about 12 weeks after the unemployment supplement cut off. It's like they just started walking in the door responding to our advertising. We literally, out of 11 restaurants, only have 2 restaurants that are short crew today. Proud to say it. I mean, everybody's struggling, but we have gotten it dialed in, and we're really, really pleased. Those 7 restaurants in Northern Ohio are, averaging 110% sales gains combined. They are hitting the average profitability numbers that I said. And for our Tasty Equity investors, our goal is to have an equity structure. So Pete and I are going to basically grant back part of the equity that we took in the acquisition and grant it back to Tasty Equity. That's exactly how we did it with the rapid fire pizza locations. We funded the stores, then we granted our equity to Tasty Equity as part of our public offering. So we're following the same model, not inventing anything new. It just takes a little time, and we will announce, but it won't change anything. You don't have to reinvest to get part of those. It'll just become part of the portfolio. So yes.
Sorry to interrupt, but since you used that topic on the last slide, that was one of the questions I was going to ask you, but you already answered it about the supply chain issues. I just had a question. Has it affected in getting supplies to the restaurant? Sounds like you've addressed it. But let me elaborate a little.
Yeah, let me share just a thought about that. So, by the way, I was listening to CNBC this morning in a CEO interview, and they said everybody blames supply chain for the last couple of months. Anybody who hasn't said I've already started to solve it is an idiot. If you can't say that, you're an idiot and you're not on track. We had more product substitutions in the last 18 months than in the history of the brand. We literally every single week, the whether it's the cucumber or the zucchini and the onions we buy for, the sauteed vegetables, or, the fajita vegetables, or the tortilla shells themselves, supplier after supplier was crippled by labor shortages. And all of a sudden you can't get the jalapeno pepper tortilla shell from this guy. And so Cisco, our supply chain partner in the hotheads, they swap in another one. The product codes are changing, the prices are changing. We had a rampant increase in, chicken went up from, $90 a case to $150 a case. Barbacoa just went up 2 months ago. But now our food buyers are telling us they're all coming back down. Over the next 90 days, the futures on all these commodity products are coming down. Why? Because the meat packing plants, the cutting plants, they're all, staffing up now, right? I mean, there was problems with chicken farms where there was not enough labor to go work the farms for reasons I won't get into politically. So now those are getting solved. It's the supply chain is relieving. And we did one thing that I credit my brother Ray for in his wisdom. He said, Chris, despite all the horrific challenges of hiring people, which we were desperate for staff, we spent our overtime expense across our 11 restaurants in the last 12 months was 25% higher. So, at a store that, maybe spent $100,000 in labor, it was $125,000 in labor. And it was because so many crew quit because of COVID, and our management team, God bless them, was stuck with us. They just pulled the hours. We had people pulling 50, 60, 70 hours a week. I still have one manager pulling those kind of hours because there wasn't any crew to do the work. Now, unemployment ended. All of a sudden, everybody wants to go back to work again. Everybody's getting some relief. But what we did is we held the line on wages. We did not just start paying people more per hour. We focus on bonus compensation, on the benefits that they get. Our crews, starting about a year and a half ago, we changed the way the point of sale system works so customers can tip in the stores. If you're in our stores, you've been part of this. And we have some stores getting an average of $3 per labor hour in tips. So that means an employee that, we're paying $13 an hour is making $15 an hour just because of the tips. And on top of that, they may have bonuses. So yeah, yes, there were supply chain problems. It's not in the rearview mirror yet, but we've learned to manage it, and it is painful, yes, expensive, yes, but subsiding. And as a process, we did take in the course of the last 18 months 3 price increases, just like all our competitors did. We basically tracked what Chipotle and Blaze and Mod were doing. So it's in a way the working class team members in our stores have benefited by slightly higher wage increases, but they've been benefited from the tip increases, which have been massive. I said customers spending like drunken sailors. Our dollar per ticket is up from almost as low as $11 per ticket per check when customers come in and eat together to $15 a ticket. That means we're getting 30% more money, or actually 50% more cash potentially for each transaction, which just massively helps the numbers as a business. With that, I think I'm on about the last slide. I just wanted to, again, pull this back to, to center. We set out to do 10 stores a year. We had 4 that we created starting back in 2015, right? But I like to remind people, those 4 restaurants, we put up $100,000 to build the first one. It produced enough cash to build the second one, so we had no more cash invested. And then we got 2 hotheads for the cost of the debt, no more cash, a little bit of cash put in. We recycled profits to fund the remodels and things like that. And then, of course, we started getting government funding to help during COVID. But the point is, we got to 4 restaurants with $100,000. And now this deal that took it to, with the additional 7 restaurants, that transaction was very economical as it pertains to cash. So we believe that if we're going to go after those 7 available restaurants, again, I can't promise you that we'll get 1, but I hope we get 2, 3, 4, maybe 5 of them, because those guys want out, and we supervise them. We inspect them every month. They're in our area. So we know these restaurants. We know what we can do with them. I think that's the kind of my wrap up. My appeal to you guys in the audience, and let's cut over to questions, is, share what you see as we're going to we cut over to the new ad platform, or sorry, the new offering platform. We're ramping up the ads. You're going to see new ads, some new content, some new videos. If you're already an investor, please share it with people you think would be investors. Anything you can do to build our publicity. Our goal is to have a very significant capital raise in 2022. We are filing next week to extend our offering. It's a very official process. We might actually even pause the offering for 2 or 3 weeks while the official SEC approval goes through. But if you're investing with us today, share it with people you think would believe. Share it with investment groups that you think would like it. We found the vast majority of our investors don't live anywhere near our restaurants, that they are allocating funds from their portfolio, and some will invest 100, and then they'll talk to Ned for a while, and they'll see one of our webinars like this, and they come back and invest 5,000. We have some people contributing money almost every quarter. We're here to take care of the money. Our job is to be judicious in how we use capital and take advantage of the tax structures. And we want to maximize the value we create, but we think we have a fair chance of creating somewhere on the order of $6 to $10 million in value growth on $1 million investment over the next 3 years. So I hope you're with us. With that, I'm going to pause for a second. Elena, feel free to rack up the questions.
Okay, great. Well, some of them I've been able to answer while you're talking. I've also been communicating with Ned. Ned's already got the follow-up. There's several investors on here that want to invest more. So that's great. So
maybe be a limited partner in a restaurant as opposed to just buying more shares. Both options.
Exactly. And that was the other thing I was going to say is I think, again, I think one of the reasons you had such loyalty, and this is more of a comment than a question, but just so people are aware, we can have additional, obviously, if you just want to contribute $100, $200, that's fine. But we do have these limited LP structures that I think with the way that the fundraising is going, I think we're going to really accelerate. So I just wanted to make that comment.
And that's a very local thing, by the way. My friend in Cleveland who said, I'll match you on up to 20 restaurants. He's interested in restaurants that are driving distance from Cleveland, right? He's not interested in funding restaurants in Florida. Right now, I have another friend in California who said I'll fund them anywhere, but we have a guiding principle. We will only fund restaurants where either we are the area developer or there is an established Hothead Burritos or Rapid Fire area developer that will have skin in the game with us when we build out that restaurant. We're not going naked into a market, stranding one store somewhere. This is a business. It's a multi-brand strategy, but Rapid Fires and Hotheads, and we haven't talked today at all about our Wiley's Wings, Tenders, and Fries operation. Ray launched last December. It's on par with our best Rapid Fires or Hotheads, and we're looking forward to expanding that brand in 2022.
And again, just a comment, and then I'll bring this question in, that some of the structures you have, and I know we've talked about this in previous presentations, but I think some of the customer loyalty is you guys are willing to offer equity and sweat equity with some of these managers. So I think you've got a lot of great people that are in it for the long haul. So, because you've been creative with your structure. So, yep. And that's something we should probably review again in case people have missed it, because we've had a good group on this entire time. A question I got from Roger Rodriguez wants to understand, besides wanting to invest more, he wants to understand how limited partners work. So I think you'd be best to give kind of a 30-second.
Yeah, no, I can give you a very simple version. And by the way, Elena or Ned could handle that on a direct phone call with you. If you're interested in that, I have a crushing schedule, but we will always make time to talk to any of our investors, whether you're a $100 investor or in trying to do something like an LP. Here's how LP works. So we go to fund a restaurant. We go to the bank. The bank needs to see $100,000 in cash equity for the deal, and then they loan us the difference. So it's an 80% loan to value. We borrow $400,000 on a typical restaurant. We put up $100,000 in cash. Our goal, as I mentioned earlier, is to not put up the whole $100,000 ourselves. I would rather own part of the equity in a lot of restaurants than all of the equity in a few restaurants. So there is an opportunity, and I'll describe it as I have for my friend up in Cleveland. He said, I'll match you 50-50. So we put up $50,000. We are the lead partner on the deal. We're all members in the LLC. He has a limited partnership agreement which says, I don't need to come to any meetings. I want a guaranteed minimum rate of return. So, I'm giving you my money. I know there's all this potential, but I want at least a minimum rate of return, 6% on my money or 7% of my money. And I don't want to guarantee any loans. I don't want to guarantee the leases. I want to be a limited partner. Limited partners are protected from those loss exposures from the perspective of they're not guaranteeing things personally. So in this business, in the franchise industry, the Small Business Administration will tell you 1 in 10 restaurants fail. I can tell you historically, I've done the numbers in rapid fire and hothead. That's about the number. About 1 in 10 restaurants can fail. We're not quite that bad, but usually it's death, as my bankers say, death, dereliction, and divorce. So what we're trying to do is we're trying to set up a independent franchisee. These people who apply to the franchise system, they have 10 years in restaurants. They've saved 50 grand. That's not enough. We're saying to them and to people in our crews, we haven't done one yet. Well, Ross was our first one. We did it with my son, Ross. But we have several people that have been with us 5 or 7 years. And we want, if I take over, we go build a restaurant in Indianapolis or in Detroit, we will make one of them the franchisee. We will be the equity partner. And if you're a limited partner with us, you're 50-50 on the equity. So think of it as you would own 25% of the restaurant. We would own 25% of the restaurant. And the franchisee will own 60%, assuming they have the capacity to sign for the lease and sign for the loan. And our goal is, and SBA loves this, our goal is to be that corporate partner. We do everything in the back office, from capital and cash management, HR, benefits, the weekly reporting numbers. We employ the superstructure of area supervisors and area managers. So when we add a store, they're plugged in under that structure. And there's a chargeback to every restaurant. It's $2,000 a month for that management overhead. And that still allows them to make $5,000 a month. So, or produce $5,000 a month in free cash flow. So a limited partner is a minimum limited partner would be $25,000. Right now, we're focused on folks that 50,000 is easy because I got to do 100,000 for a restaurant. I put up half, they put up half. But we could do a restaurant where we have 2 limited partners at 25,000 and we do the other 50, right? We want to create optionality. So as we come to markets where you guys on this call live, and you say, okay, I'm somewhere between Pittsburgh and Detroit, or Pittsburgh and Ann Arbor or Indianapolis, and I'd like to see a store done in my market. That's where we would be best to participate together on a limited partner basis. Hopefully that helps. And by the way, it's a 3-year lockup with a 3-year buy-sell agreement. So if you invest as a limited partner, we're in this for a 3-year run, right? Our goal is to grow the value of the business and then have an investor come in and buy into the business, realizing that value, and us cashing out some portion of what we've done and realizing some gains together. So that's how the deals work with Darden and RBI and Acquire Brands and the big players. So this is, I should be clear, whether it's a Class B investor, our regular investors buying stock, or a limited partner, we're not a bond. This is not a government bond business. We don't send you a check every month, right? We are a growth investment, just like all 50% of the stock market are growth capital companies. So you buy the stock, the goal is to have the value of the company increase and then have a transaction in the future, which gets you your ability to cash in on that capital gain. Hopefully that helps.
Yeah, I think that's a great synopsis, Chris. And that I already got a couple inquiries of people that are interested in that structure. So I'll make sure I follow up with you. We can set up a call.
Yep, absolutely.
And then before we jump off, just a couple of questions that came in earlier. You touched on this, but the Tasty Equity is, the ones that we own are along the corridor. But there were a couple of questions about whether or not Tasty Equity, I know you and I have talked about this. You're going to focus on that corridor, but there is some interest in Connecticut and some other things. So I didn't know if you wanted to address other locations or.
Sure. Well, I'll use the map here to answer that. So, for example, we have an area developer that we're very comfortable with in Connecticut. He's a hothead guy. He's got one store that's screaming busy. He's got one store that was in a factory town where the factory closed, and basically he's losing money on one store, making money on the other, and breaking even altogether. But hopefully that factory's back open. It's going to be better. I haven't talked to him in 2 months. But if we have somebody who's interested in investing in a store in Connecticut, then what I would do is we bring the Connecticut area developer into the conversation, make sure everybody's comfortable with each other. That area developer will help us find a suitable location. They'll help us find a suitable franchisee to operate it, right? I want the person that's got the keys to the restaurant to have skin in the game, even if they're just a sweat equity franchisee. Even if we fund everything and we sign, and Tasty Equity signs for the loans and a lease, that management team is going to get at least 20%, because we want them to have skin in the game and fight to make that restaurant perform as best as it can, maximize its success, right? So that's true. Any of those gold states, and if anybody's interested in a copy of the slide deck, we do make a handout version after each event, and that's available on request. But same thing's true, in any state you see in gold. North Carolina, South Carolina, that's where the area developer in the rapid fire system comes from. They control those two markets. They have about 5 restaurants open. Again, they are here to build restaurants. So, and maybe if you're familiar with the space, Blaze Pizza announced they're going to build up to 300 restaurants over the next 4 years. So, everybody's seeing growth opportunity here.
Yeah, I think it's great. So that was the only question there. We already addressed the supply chain. We addressed the limited partner structure. And again, Ned has been very actively taking notes along with me to make sure that calls are scheduled for people that want to invest more money, which obviously we're very excited about. So, but any other questions? Like I said, Chris will publish this, and then you have Ned's information and my information, and if there's any other follow-ups or one-on-one calls we can do. So
and if it's not obvious, you can reply to the invitation to the event. That'll get Elena. If you can always go to the website and hit contact us, and that'll go to Ned. He'll field those calls. And again, we're always happy to get on a call and talk to our investors about their view, ideas, creativity, a product thing, something, like we had one of our rapid fires in Texas testing wings, right? I mean, they're selling wings. Why? Because Pizza Hut Wingstop did that, right? By the way, did anybody notice how Wingstop came out with a big announcement that, well, we're having a little trouble getting wings, so we're selling thighs now. It's like, wait, if you don't know this, it's secret about our business. Chicken thighs are the core product. It's probably 70% of what we sell. When you buy a bowl, a burrito, a taco, fajita setup, however you buy it, if you specify chicken, it's chicken thighs. That's the best product for chicken. But anyway, we have a wings business now with Wiley's Wings, Tenders, and Fries, and so we're experiencing these supply chain shortages there. But again, we're told they're all coming into line. So give it another 90 days, things should be back to normal. So. Well, listen, there's been a large group of you who have been with us the whole time, even some of you from 10 minutes before we started. We really appreciate your participation. We appreciate your feedback. And even if your feedback is you do or don't like our format or is something we can do to improve it. I've been doing webinars for 20 years, and Elena's been doing with me for 3. We have evolved our style. Hopefully this style works for you guys. I know my legal team and my ad team says get it done in 20 minutes. I'm really not very good at getting it done in 20 minutes. So thanks everybody for joining us. I think we should about ready to wrap up. Is there any more questions before we wrap up?
You know what? There was just one, but I'm going to just personally reply. It just said, I've invested $100. Where do I come in at? I didn't really understand what that meant. Does that make any sense to you?
Well, let me just answer that question. So if you've invested $100, first of all, you can go to Core Connects and you can see your account where it's like a broker dealer account where those shares are held. They are angel investor equivalent shares, right? You're investing now for us to create value with that money later. That $100 as an equity ownership share of our existing 4 restaurants. And once we get the equity transaction done on the new 7 restaurants, assuming it gets done, I have to say disclaimer, the SEC we have to get this done correctly with the SEC and SBA and our lenders and all that sort of thing. But our goal is to grant back 5% each from Pete and I to the Tasty Equity entity, so that if you invest $100 today, you own part of those 4 restaurants. If we can get this transaction accomplished in the next 60 days, then you will just automatically you just own more parts of more restaurants. So that's how it works. And we actually have a special provision that's worth noting for you guys who've stayed on this long in our operating agreements. In the future, when we have a liquidity event, again, we're like many closed-end funds, we're focused on a 3-year development cycle, and then we figure out the next 3 years after that. But our operating agreement, our legal documents filed with the SEC say that at such time as we have that sort of agreement, any premium that an investor comes in and say they buy 70% of the company and say, okay, you guys are doing great, get to the next 100 stores, right? So if they buy in, then they're essentially buying some of the equity in the company, and our investors get the opportunity to liquidate shares into that transaction. This is a process that's been used by, like, Brewdog, is the brewery in Columbus that inspired us to do Regulation A. So they just took on an investment of 10% of the company. It was at a much higher value than the shareholders bought in, and the shareholders were each allowed to liquidate, to offer into that transaction, some percentage of their shares and basically get the profits. So is at 3 years out. So in the meantime, the more stores we build with the same pot of money, the more your $100 becomes more and more value. And my point about what I was trying to explain there is a provision that says when that liquidity happens, our investors first get the opportunity to get their money off the table. Before Pete and I take any money off the table as owners, our investors get to get whole on their investment. That makes sense. And then we share the profits after that. It's very much like a traditional private equity fund. That's the kind of structure we've copied.
Great.
So with that, I'm starting to stray into the area where my attorney would be saying I have to say disclaimer a lot more. That we might not be able to do this. It might never happen. Unforeseen circumstances could derail us. But you know what? My family's been in this business since I was, born. We are, 3rd generation of Pizza Hut people. We didn't own Pizza Hut. My dad worked for Pizza Hut. He was the 5th guy there, 6th guy there. And, those were our mentors. And, we come from generations of people who've been doing this, and networks of people who've built many brands. So I was at the 60th anniversary of Pizza Hut about 2 years ago, and there was probably 50 brands represented in the room where the founders were there, and they all came from Pizza Hut.
That's amazing, anyway, Chris.
Everybody have a great day. Thanks for your faith in us. And we've survived COVID. We're coming through the other side. Hopefully the 5th wave won't, slow things down, and we're going full speed ahead, try to acquire those locations. And we'll report back in another month. I'm not sure if we'll do a webinar event in December just because of all the Christmas noise. So we'll probably see everybody in January. So anyway, have a great day. Thanks, Elena. Thanks, Ned.
Okay. Thank you. Thanks, Chris. That was awesome.
Emails. Thank you. Bye-bye.